Hi guys, thanks for tuning in to another episode of Nuggets News. And tonight is our 1000th ever episode. So why not have Martin on, who's been one of our most popular guests, particularly while crypto's in the doldrums. Martin, our crypto videos don't get as many views. So you wanted to focus a little bit on Australia tonight?
Yes, well, congratulations on 1,000. That's great, and well done. I mean, we're a bit ahead of that on DFA because we've been making daily shows for the last 5 or 6 years. But look, there's a really big conversation to have, and I think we're going to do it in two parts. Firstly, let's talk about some of the international issues relating to inflation and the Fed decision and what's happening there. But I'd like to focus in specifically on Australia tonight because we have a population Ponzi the likes of which we've never seen before. And frankly, it's wrecking people's lives and could wreck the future. So I thought it was worth focusing on that for a change as well.
Yeah, absolutely. And as Martin mentioned there, guys, 3,500 videos. So he's been working three and a half times as hard as me. But yeah, thanks to everyone that has been supporting our channels, and particularly this episode, which continues to rack up plenty of views. And obviously, if you're into all the crypto stuff still, we've got our website and our premium research stuff for those of you that are wondering if we're still doing all our crypto work, which we are behind the scenes. So, Martin, let's jump into these fantastic slides of yours. And inflation continues to be pretty sticky.
Yeah, it is really interesting because, of course, the official narrative was that inflation was going to come and drift lower. We went through the supply shocks. They put the interest rates up, but inflation isn't playing ball. And so you can see here from the chart there that inflation in the UK is still very high, about 6.7%. In Germany, in France, in the US, and Japan. And it's worth reflecting that, of course, interest rates have been moved up in the US. The Federal Reserve didn't move yesterday, but they did say very firmly that this is not going to get fixed quickly. Rates may have to go higher, so they've still left the door open on that. They're talking about rates higher for longer. And in fact, the ECB last week put rates up again and said pretty much the same. They're being data dependent, which basically means that they'll wait to see what happens. But the truth of the matter is that inflation is not tamed. In Australia, we've still got very high inflation too. Why? Well, there's a few things. One is we've got the supply chain disruptions beginning to perhaps ease back a little bit now. But now we've got a bunch of other issues. We've got the deflation coming out of China, maybe. We've got the exchange rate movements, which are actually quite extreme and actually putting more pressure on local economies, particularly Australia. But we've also got now services inflation, which is linked to wage growth rising still. And then, of course, we've got higher energy costs, particularly the oil price, which is now above 95. That was unexpected. And that's partly because of what OPEC's done, but also because of the supply demand disequilibrium there. So the story is inflation is not yet crushed. And so the debate has been for the last little while, will central banks change their targeting? Well, the Fed said, no, we're still targeting 2%. In Australia, it's 2 to 3%. Interest rates, of course, in Australia is, the cash rate's still at 4.1. In the US, it's above 5. The expectation is Bank of England may well lift again today. They're up 5 plus already. So Australia is an outlier. But the point is inflation is still with us. And, the history from when we were in this position a few decades ago is it takes a long, long time to this to get ground out. It takes a long time for the boat to sort of change direction. And I think that's now, the market is now beginning to wake up to the fact that maybe rates will be a lot higher for a lot longer, and there are consequences for that.
Yeah, and I think we've both been reading some of these articles and data that have been coming out at the workforce level about unit labour costs going up while the economy unemployment's so tight, and productivity going down. And Australia really being one of those countries that's not keeping up with leveraging new technologies and spending more investment on upskilling workers and that type of thing. Maybe it's that laid back approach that we tend to have, but in this global workforce, and as things become more digital and interconnected and AI becomes more competitive to do things elsewhere, that's something that's also going to hurt us relative to other economies.
Well, that's true. And of course, our economy, the old houses and holes story, right? We basically dig up stuff and sell it to people without much value added. And then we spend a lot of time building stuff, particularly housing, investing a lot in houses. I mean, that's what the Australian economy is. Unfortunately, now, some of the future demand for some of those resources could well be going off the boil, particularly if China continues to struggle. And China's done some things, but they haven't made major strategic investments in terms of trying to get the economy back on track, quote unquote, from a Western perspective. What they're doing is a little bit of massaging around the edge, trying to protect the property sector, trying to, they define, for example, differently owner occupiers and investors, and have given a little bit of a leeway there, dropped some rates, but they're not doing a huge amount. And markets are still expecting China's going to do a massive stimulus. I'm skeptical of that. If China continues to go sideways or grow slowly, demand for our resources will continue to probably go backwards. And then you come back to, so what else do we do in Australia? What is it that Australia does? The answer is not a lot. We don't do a lot of really productive stuff. We don't do a lot of innovative stuff. We've got a lot of people working in the services sector. A lot of those, of course, working in healthcare and allied areas, which are very important, but those services industries don't actually create extra value. What they're doing is just shifting the same dollar around the system. So the growth engine in Australia is spluttering. And frankly, the government's not really that interested. All they're doing is, we'll see in a minute, they're just saying, well, we'll bring more people in. That'll solve the problem. No, it won't. It'll just create more problems.
Yeah. Okay. Next slide. We've already discussed this, but anything specifically you want to add?
I just wanted to say the rates higher for longer slide here. This is the 2-year US rate. Now, this is an important rate because it gives you a little bit of a flavor of what the expectation is of rates. And now we're up well above 5%. And if you just look at the long-term trend, you can see here, this is pretty much now where we were briefly in 2006, but then 2001. We have not been anywhere close to this. So the expectation of the markets now is that they're going to stay high. And the next slide, which actually came from Wall Street, which was a really good slide, makes the point that now there's a plateauing effect. So once rates go up to their top level, they stay there for a period. Now the question is, how long will they stay high? Is it 7 months, 14 months, 8 months, whatever it is in the US? Now, this is an important concept. Rates are going to stay high for a lot longer. And if inflation is as stubborn as we think it is, because of course the US is doing quite well from a GDP perspective, they've actually upped the GDP expectation. It may well be that we see interest rates higher for a lot longer. And perhaps we're going to come back to an environment more like we saw before we had the 2006, 2007 crash, and therefore rates cut to bilio. And, maybe this 0.1% that we went through in Australia, that's an aberration. That isn't normal. So the expectation of rates coming back quickly to much lower levels, you've got to write that off. We're in a much different environment now, which changes the world around, for example, borrowing for property, real returns on investments, real returns on interest in the bank as well. If you've got money in the bank, you can get quite strong interest. So it changes the world. And I think that we haven't yet fully understood the implications of higher rates for longer. And maybe we're never going to see the central banks pull them back down to where they were.
Yeah. I might share some thoughts on that later on when we get to those property valuation slides. But the other thing you mentioned there was the ability to stimulate with governments, as they have done in the past, where at these rates, bond investors are starting to say, well, hold on, the amount of bonds you're going to issue and Bidenomics, as it's called, these huge, huge deficits. So there's not that appetite there anymore either, which it makes it harder to do these huge $1 trillion QE, stimulus packages and spending packages and so on, because globally investors are going to say, well, I need to get higher rates, and that makes it more expensive for governments to even pay the interest on their debt, which they're starting to struggle to pay. So that's an interesting phenomenon as well.
Well, you're spot on there. And so there's a big set of unknown unknowns. For example, will there be another debt ceiling issue in the US? Quite possibly. We've got strikes in the automotive sector in the US, and there they've offered them 20% and they didn't wage improvement, and they didn't actually accept it. I mean, the world is moving. So there's a lot of big unknown questions here. And of course, we've still got, the Ukraine situation with Russia, the war there. We've still got, big international forces. We've got the BRICS thing in the background. So we're in a very, very uncertain time at the moment. But one of the things that bond investors are now saying is, because of those high risks, I need higher returns. And the 10-year is quite high, but the 2-year is, in the US is above 5. That's a really important benchmark. And I think that's going to signal some very significant and bumpy roads ahead.
Yeah. Okay, so Australia's population, Ponzi, people can follow this chart pretty clearly. It's a pretty steep line.
It's scary, right? So basically, we're seeing now 550,000, 600,000 people coming into Australia. The government has turned all the taps on to try and bring people into the country. And it's interesting that many other Western countries are doing the same. Canada's doing the same. New Zealand's doing the same. The UK, less than now, but they were. Why? Because growing the number of people in the economy is seen, from Treasury's perspective, as the only lever to pull to try and keep the GDP going in the right direction. Because, as we said, productivity is going through the floor. So we've now got massive population growth. The question is, where are they all going to go? Where they're all going to live? What are they going to do? How much are they going to be paid? And these are very, very significant questions, because it could actually mean that for those people already in the country, the standard of living continues to deteriorate big time.
Yeah, and that's an important point, because we can't keep up with infrastructure and the living standards if we're bringing that many people, so standard of living goes down. Do you think it's not as big a political issue in Australia as it is, say, in plenty of other countries at the moment? We see those headlines. Did you see Elon Musk tweeted today a million people a year coming illegally over the US border and that type of thing? So I feel like it gets more of a run in these other places, but do you think it's going to become more of a political thing in Australia if people start to see their standards of living drop substantially?
Well, I think until now, this has not been a conversation in Australia that people wanted to talk about. So, in the mainstream media, they didn't hardly talk about it at all. In fact, Tarek Brooker, who's on my channel from time to time, did a very important article the other day and basically just repeated the story about all the levers that have been pulled and the growth. And he got hit over the head by a 4x2 on Twitter from people who should know better, because they didn't want to have the story told. But now more people are starting to raise the question about, hang on a moment, this is a set of policies by design. This is a deliberate strategy by Albo to bring more people into the country. And there are consequences. And, we should have a conversation about this. Shane Oliver at AMP wrote a really brilliant piece the other day highlighting it. So we're starting now to see in the local media in Australia, particularly social media, some discussion about this. And the fact that big Australia benefits corporates, benefits the government because they get more taxes, but it doesn't benefit ordinary people. It doesn't benefit those who are trying to get into the housing market or those renting. It doesn't benefit those trying to travel around. And so the consequences of just blowing up the population for no real reason other than trying to keep the GDP positive and to get more taxes to be able to do things. It's a nutty strategy, and yet I don't think we were consulted at the last election about big Australia. And in fact, I recall beforehand, the Labor side of politics was much more, wanting to sort of play that down. Trouble is, both sides of politics, up until quite recently, have really followed the same route because of Treasury's guidance. But maybe we will see the other side, the opposition side, start raising questions now, and there have been some raised recently. So very interesting to see how this plays out. But this is a big deal.
Yeah, to be clear for everyone at home, this isn't a sort of racist conversation or anything like that. You can bring in a number of people of any ethnicity or age, gender, whatever, and it's going to strain infrastructure and healthcare and all that in the same ways, even though Australia's already multicultural. So, yeah.
Spot on. And on the next slide, just to show you how much of a deviation from the projections just from May, right? So they were expecting that the population growth would, well, there'll be a bit of a post-COVID peak, but then it would slide down again. But of course, no, it's now gone way off the scale, right? So this is a strategy that's been deployed in the last year or so. So this is new. And if you go to the next one, which is basically by different classes of visas, you can see there that there's been a massive spike in visas according to the Department of Home Affairs. And you can see there that some categories have gone absolutely through the roof. Students, of course, as you'd perhaps expect, but other temporary residents of various sorts as well. So we've had a massive rise with a fall in bridging visas, by the way, in here. So this is a series of levers that have been pulled deliberately by the government. And if you ask the question why, it's because I think they're quite concerned about the overall performance of the economy. And so they're trying to sort of mask bad performance by just pulling more people in.
Yeah, I think we've spoken about this before as well. If there's a certain number, 100,000 or forced sellers of properties and that type of thing, if they can kind of plaster over that with people immigrating in, it's fine. That might support property prices to some degree, but it's all these other flow-on effects that are worse longer term than if you had to just let housing correct another 5, 10, 15% naturally.
Correct. Yeah, and I'll argue the thesis that one of the reasons why property prices are still where they are is because we've got this extra demand at a time when there are smaller supplies of properties coming onto the market. So supply demand. And rent is where it hits first. So this next chart is from Shane Oliver, and it's a really brilliant chart because it shows you the average rent change and how the vacancy rates have moved in the other direction. Why? Because we've got more people coming into the country. And what do most people, when they come into the country, do? They need to rent somewhere. So we've had this huge extra demand for rental property, actually at a time when the number of rental properties available is decreasing, and we'll come on to that in a second. So we've got a rental crisis, the likes of which I've never seen before.
Yeah, so what's that, 20% annually high since back in the 80s? Yeah.
Yep, that's spot on. And in fact, the next slide, which sort of is an article, says national rent vacancy rates hit a record low in August as elevated immigration inflated the tenant pool at a time when more landlords are selling up. And there's data there from PropTrack. I mean, this is, those two things coming together is creating the problem. And in fact, the total vacancy rates are pretty much low wherever you look. But on the next slide, you can see that actually from PropTrack, they actually showed that there are some significant swings, Sydney, Melbourne, as you perhaps expect. Interestingly, the ACT is in a slightly different position, but across the country, we have massive issues with regard to vacancies and availability of rental properties, and particularly close in to the main urban centres.
Yeah, they are some standout numbers there in ACT, but everywhere else, dramatic changes, yeah.
And interestingly, in the ACT, of course, ACT is one area where there are rent controls in place. So landlords in the ACT can't put rents up as much, whereas, of course, because of the supply-demand disequilibrium in many other places, the rents are rising. And in fact, this is another chart which shows, this is from CBA, it shows the rent in the monthly CPI, which is sort of showing at a 6 to 7 or 8%, give or take. But the true advertised rents for new valuable properties has been much, much higher. And so there's still an upward inflation pressure coming from the rental sector. So rents are going to continue to go higher, I don't know how quickly, because of this massive supply issue. And so one of the big things to understand here is that this population Ponzi is directly impacting higher inflation.
And as we can see, yeah, that tends to the advertised rents tend to be that leading indicator as well. So expect the CPI to follow, continue higher.
Now, the other consequence of that is, of course, that we saw property prices, slide a little, and the total value of property in Australia fall a little. But now that's reversing. So the latest data came out to say that the total residential value in Australia rose by $325 billion to more than $10 trillion this quarter. And the number of residential dwellings rose by 52,000. So just bear that in mind. 550,000 people coming in. How many extra properties have actually landed over the quarter? 52,000. We're not actually, so there's a supply to demand disequilibrium. And as a result of all that, the mean residential dwelling price rose by $25,000 to 912,000 on average. Now, and that's an average, and it masks a lot of differences, but that's a scary number, right? So basically, what we've now got is this massive Ponzi scheme pumping the property market, driving prices higher, and making it harder and harder and harder for ordinary new people, first-time buyers, to get into the property market.
Yes, the perfect storm. So, do you think we're going to see another rate rise this year, Martin, seeing as Australia's so much further behind, as you mentioned before?
Well, I think that we're only at 4.1, and that's not enough. Inflation is a lot higher. So the theory is always that you need to get the interest rates higher than the inflation rate to be able to pull it down. The most recent data for Australia is show that inflation was beginning to tip up. We saw the rise in energy costs, and I'll just show you in a second. We've got more issues with regard to fuel and some of those things. So my expectation is a rate rise on Melbourne Cup Day.
Yeah, because the RBA, I think we mentioned this last month as well. The RBA and their own research has been saying that 3.8% might be that natural rate of inflation. So if you're only at 4.1, a little bit above compared to the UK and the US, Canada, where they're at 5%, Australia is just so much further behind and starting to hit that Aussie dollar really hard, which we spoke about as well.
Well, we'll come on to the Aussie dollar a bit later because it's a big deal. So just sort of standing back, we've got inflation coming through from high rents because we've got the question of population driving the demand. The other factor, of course, is that rates have already gone up a lot. So the next one is from CanStar, and it's just highlighting where we currently are. So, $500,000 mortgage in April 2022 cost around $2,100. In September 2023, it's up to $3,320. So that's a total change, a very significant change. But if rates went high, it will obviously go up high. These are huge movements in what people are having to find to spend each month. And so we've already got this massive pressure building on a whole bunch of households. And as we'll see, mortgage stress continues to rise. So already the inflation battle lifting rates is having a huge impact on those with a mortgage. And those with a big mortgage, of course, are paying even more.
Yeah, and we can see that there in the servicing costs.
Yep, this is from CBA. It just shows it's going through the roof. And of course, on the next slide, we've also got, as I keep reminding everybody, this is the updated one from CBA. The fixed rate cliff is still rolling. So we've still got, more people to come. It's about 60% through now. But, if you were on a 2% mortgage, you're now on a 5 or 6% mortgage. And as I showed through the CanStar data, translate that into the cash flow terms, it's a big deal, right? So that's a really important thing to understand. A lot of people are being caught by this. And in fact, if you then go on to the next part of the story, a lot of investors are actually now not able to make their investment property work. So there's much more anemic capital growth, but this cash flow pressure because rates are so much higher. So we're seeing now a lot of investment properties coming up from being available and they're now being sold on the market. So this is from a quarter of Melbourne property investors sold at least one rental house in the past year, according to this research here. Investors flee Melbourne. And, there are some specific things in Melbourne. There are some changes to Airbnb. They've just announced that they're going to actually start taxing Airbnb and similar short-term lets with higher costs. We've got less rental supply as more investors are quitting. And in my modeling, about 60% of property investors are underwater from a cash flow perspective now because of this significant rise. So you must expect the supply of investment properties to continue to evaporate at a time when the population Ponzi is pumping more people into the country. It's a mess.
Interesting you mentioned Airbnb there as well, because I know in commercial real estate I was reading, I think sometimes we forget that even in Australia there's these other international companies that their bases here, like WeWork, and they pay something like $900 million in rent in Australia, and they're a company that's currently going through restructuring and collapsing. So there's all these other international firms that have offices here, and we see those office vacancy rates creeping up, particularly in Melbourne and Sydney. So all those things come into it, and those real estate investment trusts that we've spoken about in previous episodes is now trading at a 30% spread to what the funds are saying that these things are valued at versus what people are willing to pay for the shares, or even out there bidding. There's just not that appetite, and these really are liquid assets that people are pretty heavily invested in their retirement funds and might not be aware of.
Spot on. Of course, a lot of it's unlisted. The other factor that's now starting to come to the fore is that some of those commercial properties are now being repurposed as residential properties. But of course, there's quite a long construction cycle in that. So they're trying to find ways to reduce the stock of commercial property because they just can't find, offices in particular. So expect to see more high-rise living, ex-office conversions as we go. But it's going to wreck the commercial property sector. And it's happening, by the way, not just here, but it's happening in the US and in the UK and other places too. So this is another big factor in the sort of, the weird world that we're in at the moment.
I'd be interested to know from our audience if anyone works in that sector, if they've seen any commercial real estate getting changed over to residential or apartments, whatever, and the red tape around that and the different specifications. So if you're out there, I'll be very interested in that. What's happening on the front lines below in the comments.
That's a really good question. Yeah, absolutely. So the next chart is just the exchange rate. So the Aussie is pretty weak, right? And I put a chart here right back to 1995, just to remind everybody that in 2015 we were above parity with the US dollar, and we're now down at 64. Now, the thing to understand is that as the exchange rate weakens, the costs of imports rise. So what we're actually now doing is we're importing inflation because of a weak exchange rate. Why have we got a weak exchange rate? Well, Alex mentioned it. Because our interest rates are at 4.1, where interest rates in the US are above 5, and in the Eurozone, they're higher too. So our exchange rate is out of kilter because our interest rates are out of kilter. And so the question is, will the RBA sit on their hands and let the exchange rate continue to go lower, which means importing more inflation, or will they have to lift rates to be able to try and pull the exchange rate back? That's a really big question because at the moment, going on to the next slide, oil prices, of course, are high, as I mentioned earlier on. Brent was was well above 90, as well as WTI. Looking at it translating into local costs for fuel, we're at well over $2. $2 a litre now. And I was talking to somebody the other day who's just paid $2.20, and it's still rising. So fuel costs are rising because of the high oil costs, but also because of the exchange rate problem we've got. Now, remember that when we peaked higher a year or so ago, the government dropped the excise duty to help. They're not doing it this time. So this is another impost on households and businesses. And of course, the cost of energy is the cost of getting around, and that then flows on to a lot of other sectors, transportation and everything like that. So this is another question with regard to how high inflation is going. This exchange rate movement and oil movement is another profound question for us.
Yeah, and the other interesting dynamic it creates is that good for our exports, but a lot of that is the big mining companies, and so maybe good again for the people that are wealthy and own lots of shares, or the execs at the mining companies. But if oil prices to the roof, obviously that's bad for everyone else that has to not only pay for petrol at the tank, but it flows through to agriculture, and then food prices go up and everything else. So once again, something that's going to hit the small end of town and possibly benefit the big end of town.
Spot on. And also some analysts are now suggesting that oil could go above 100 US. And, if it does that, then that's going to put even more pressure on ordinary households. And what I come back to in all of this is that we it's the ordinary households that get hit over the head by a 4x2, whether it's rents, whether it's higher mortgage costs, higher food costs, transportation costs, et cetera, et cetera. And what's the government doing? They're bringing more people into the country to try and prop up top line GDP growth while actually making it worse, as we've discussed. So there's a real disconnect. And it's interesting that Phil Lowe, in his final speech, started to draw an important connection between monetary policy, which is the interest rate lever, and fiscal policy, which is what the government's doing. And he said, actually, there's probably a need for a stronger connection between the two, because at the moment, maybe they're pulling in two different directions. Of course, the government is quite happy to blame the RBA for all the problems because it's interest rate related. But actually, my argument is a lot of the problems we've actually got in Australia are specifically because of bad policy that the government's been executing.
Yeah, and a change of tune from arguing the importance of having their independence in the past, maybe saying it's time to work more closely together. Yeah.
Well, at the time when Chalmers is saying, no, no, we don't want to have any control over what the RBA does, they're actually pulling back. So it's a fascinating question, and it goes back to a fundamental question about, well, surely there has to be some relationship between what fiscal is doing and what monetary policy is doing, rather than actually pulling in two directions. And Tara Brooker again talks about, putting the foot on the brake and the accelerator at the same time, and you get this burnout economy effect where you've got this massive flood of people, huge inflationary pressures, and yet interest rates not in the right place. So it's a mess.
Yeah. All right. Moving on, consumer confidence remains fairly low.
Yeah, so this is the latest Ray Morgan. It coming up a little bit from but look where it is. It's nowhere, and that's because, of course, real ordinary people are saying, "Hang on a moment, I smell a rat. This is not working for me. The economy isn't working for me. I'm spending a lot more. My real wages growth is not keeping up with what's going on. Inflation is still very high. That level of consumer confidence, if it continues, will translate to lower levels of retail spending. And that's important because more than half of the economy is retail. It's us buying stuff. And on the next slide, Roy Morgan analysis suggests that we're going to see retail begin to ease back now, as more people have less to spend, as they hunker down, as they see these rates higher for longer. So it may well be that we see weaker economic momentum in the retail sector. And if that's true, then we could definitely have an issue. And on the next slide, just to sort of complete the picture, the latest data showed more people again are working multiple jobs. Why? Because the only thing they can do to try and get by with all of these pressures we've been talking about is to work more hours, or if you're in part-time employment, work more jobs. And there is a growth in part-time caring jobs and, in the sort of the social sector, which are relatively low paid, a lot by women. But there are more people working more hours and more jobs to try and get by. And that's a consequence of all this policy stuff we've been talking about.
Absolutely, absolutely. Business survival rates. This is another thing that's been pretty chaotic globally in terms of the US default cycle, and even starting to see now in Europe. Maybe not so bad in Australia yet, but interesting to see how this plays out, because as we've spoken about, building and that type of thing is such a proportionally high percentage of our economy, and if that all starts to tip over commercial and whatnot, it's going to hit us harder than the rest.
Well, certainly we've got big failures in the building construction sector. There was a couple of firms in Adelaide went pop over the month, others in other areas too. So a lot of half-finished properties, which maybe won't get fixed for some time. But yeah, the data from the ABS showed that in fact we've got a continued failure rate, which is quite high. And you can see here that half of the firms that began in 2019 have permanently closed. That's a significant observation. So people try and form a business and then don't manage it and fail. And I was speaking again to somebody in the liquidation and insolvency business, and they've never been busier. They've got more and more people knocking on their door saying, we got problems. And interestingly, quite a few of those businesses have got mortgages because their residential property is actually in hock to support their business. And so one of the reasons why I think defaults are going to go up is not mortgage stress directly yet, but it's actually the failure of businesses. And as people fail, then they have to sell the property to be able to close the business. So expect delinquency rates to rise, default rates to rise, thanks to this. And a lot of this is because of COVID and post-COVID, but now it's getting to a bit of a crisis. So that's why this is an important topic.
Did you want to highlight any of the stats specifically there, Martin, or move on?
Well, just to say that small enterprises are substantially more likely to fail than larger business, with the survivor rate for sole proprietors of 41.5%. So just think about that. You've got a 60% chance of failing if you're a small business.
It's a lot worse in the crypto sector, Martin. I think 99% of crypto projects fail. So, but yeah, and somewhere else on that curve is tech and startup and Silicon Bank and all that sort of thing. So, also comes into play with that bank lending and the non-banks going to riskier lenders. So a lot of these official stats we get are from the best sources and whatnot. So a lot of stuff to filter through still.
Absolutely. So this is something to watch. Expect high levels of defaults, but it's to do with small businesses failing. Yep. And then just the last couple of slides, my mortgage stress analysis has gone up again, particularly for the rental sector. No surprise, because you saw all the data earlier on. Mortgage stress is also close to half of households with a mortgage are now in cash flow pressure. The longer that rates stay higher, the more that people are going to get into difficulty. Real mortgage rates are a lot higher. Real incomes are not growing. Other costs from inflationary pressures are still there. And just to underscore to everybody, if inflation drops from 6% to 5%, that doesn't mean that prices are coming down. It just means that the rate of growth of prices is not quite as fast. So yes. Until we actually see negative inflation, right, it means that in real terms, costs are still rising. So your mortgage rate, your rental rate, your costs of food, costs of petrol, power, all of those things. No surprise then that we're seeing difficulty. And just to sort of round out the discussion, I thought I'd just put on the table, the best scenario from this point in my Goldilocks zone story is that we keep rates at 4.1% and they ultimately fall next year ahead of the expectations from the RBA and wages rise faster without a recession. That's the best case scenario that I can see at the moment. The base case is maybe a soft landing where you have to put rates up a little higher, maybe to 4.35%, which means that mortgage rates will be at 6.75 to 7.5%, and they will stay higher through 23 and into 24. Inflation sticks around, but comes down towards target in 2025 without a recession. And the nightmare scenario is, and it's still quite a likely scenario, is that we see rates rise a bit. They stay high through 24, but because of those international forces, China and other things, we actually see wages growth stalling, and then we see a recession, and then they cut rates, but they cut rates too late. So we actually go into another grind down. So those are the three scenarios I see. I don't see a scenario where rates drop over the next few months back to anything like they were before we had the last rise up. And that means that for a lot of people, this journey is going to be really uncomfortable over the next year or two.
Yeah. Well, whichever one of those scenarios plays out, we'll continue to update everyone with our monthly episodes. And if you want more regular data or episodes, obviously links to Martin's channel down below where he makes daily episodes to keep that video count notching higher. So thanks to everyone for joining us for our 1000th episode. We do appreciate the likes, subscribers, and all the comments as well. So we'll talk to you again next month. Thanks, Martin.
Cheers.
Thanks, guys.